Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross, and hope you had a great Canada Day.
And same to you, Jim. And it's always a great day to live in this great country of Canada.
Ross, last month, you warned positive sales gains reported by several real estate boards across Canada were false gains, and they would return to negative in June. Has early data supported that warning you issued?
Well, sadly, Jim, the data really has no choice. It's got to go where the housing market is headed. And regardless what you hear from your local real estate boards or your local realtors in a given month, their read of a housing market is simply false. And we're being shown that already today, Jim. This is the second day of July, and already in Calgary, the Calgary home buyers who purchased a home in June on the false belief caused by the Real Estate Board of Calgary by stating in May that home sales had risen for 2 consecutive months is coming home to roost. Those home buyers who purchased a home in June in Calgary, believing that the market was getting hotter, sales were increasing. We're going to wake up today, or sometime tomorrow, I guess, when the Calgary Real Estate Board does its release, and they're going to find out that June sales dropped year over year. Now, I can't imagine what it's like to be a home buyer, trusting that the information you're being given is correct. And when you're going out and spending on average $570,000 for a detached home in Calgary, that the 25-year commitment you're going to make to paying off that home based on the price that you pay for it is happening with you getting honest and truthful information, which everybody in Calgary, once again, for the umpteenth time since 2013, is learning it was wrong, false, misleading, misrepresentative. There are real estate boards coast to coast, from Victoria to Vancouver to Kelowna to Calgary to Edmonton to Saskatchewan to Regina to Winnipeg to Toronto to Montreal, all the way up to St. John's, where June's numbers will not equal the forecast the real estate boards were making in their statements in May. And the reason for that is no one uses trading day adjusted home sales data. They use month-over-month comparisons year over year, which with real estate statistics or data, you cannot do. Everything that people understand about a housing market are rooted in these myths and falsehoods. They became myths and falsehoods the moment that buyer agency became legalized in Canada in and around 1995. So around 1995, the first rumblings of buyer agency began to take place. What that means for the first 70 years that organized real estate existed, the only person ever represented in a transaction, your parents, your grandparents, your great-great-grandparents, your uncles, your aunts, anyone who purchased a home as a home buyer had no representation. The legal responsibility of the entire real estate industry for 70 years was to get the highest price possible. Now, we are now 20 years, Jim, into the legislated change to buyer agency, and we still are seeing no different house price metrics created or released. We are still seeing seller beneficial metrics released. These seller beneficial metrics are designed specifically to cause house price inflation, house price illusion, which in turn allows commissions to be paid. The greatest fear of any realtor in Canada is they're going to knock on the door of someone they sold a house to the year before, and that owner now wants to sell, and the real estate agent can't sell the house for a higher price, a high enough price, that the owner at least breaks even while paying their commissions. And that is what the entire real estate brokerage industry is built upon. Back in the 1970s, when my father started in the business, and the 1980s, the end of which I started in the business, this was a known fact. The reason why real estate stats are created for the way that they're presented to the public is to facilitate commissions being paid in years when house prices aren't actually rising. Because no seller wants to lose money when they sell their home. In May, in Calgary, actually April and May, were seller beneficial months in almost every single real estate board across Canada. Meaning, the way that the calendar year rolled out and that behaviors of the local real estate agents who respond to the MLS rules and regulations reporting days requirements cause, generally speaking, 6 months of the year to be seller beneficial and 6 months of the year to be buyer beneficial. Some years it's 7 and 5. And then the following year, of course, it would be 5 and 7. But these irregularities, these specifically designed products of real estate stats are solely designed to allow real estate agents to get commissions. That means, the market's good in April and May, or looking better in April and May than what it was the months before. And all of a sudden in June, it's returned to its old path. The constant holding the carrot before the home buyer has been going on in the real estate industry since the first home was listed for sale. And that's what happened in Alberta in June. An entire province of home buyers were conned into believing the Alberta housing market was getting busier, when in fact it was not. The housing market was continuing to trend negative. It's even worse now in most municipalities across Canada because within the last 3 years, they brought in seasonally adjusted stats. Seasonally adjusted stats were brought in as soon as the housing market started to slow down. They weren't brought in while the market was getting busier. They were brought in when markets were slowing down. The press releases from organized real estate from across Canada slowly started talking about seasonally adjusted numbers. Why? Because it magnifies these seller beneficial and buyer beneficial months. It magnifies the up and down graphs that are created with a seasonally adjusted stats. Instead of showing the nice, perfect, level line that all housing markets follow.
Ross, should real estate stats be seasonally adjusted? Is there such a thing?
New home sales can be seasonally adjusted. Okay, Jim? So the reason why you can seasonally adjust new home sales is because the builders, the developers, follow seasonal patterns themselves. So they bring inventory to market almost in the same timeline in the same months every year. That new inventory comes to market because it is seasonal. Then home buyers interact with those new homes, similarly in a seasonal pattern. What doesn't happen, though, Jim, is that the closing dates on those properties follow a seasonal pattern. Sure, builders want to get the job finished before the snow flies. Sure, builder doesn't want to be building, putting foundations in the ground in the middle of the winter. So they align the closing dates on their properties to meet how the season flows on the other end of the transaction. Those impacts to a housing market have overflow into the resale housing market, because a lot of the new inventory, well, the vast majority of the new inventory built in Canada in the last 40 years has been single detached homes. I know we've had a bit of a surge in condos recently, but the vast majority of new homes across Canada, Canada-wide, were single detached homes. That means the buyers for those homes were already homeowners. They were simply moving up the property ladder into a larger home that the builder was building. So that brought some seasonality into a resale housing market, except that seasonality was also cyclical, rendering the seasonal adjustments under the definition of what can be seasonally adjusted impossible. So long story short, I would always tell anyone looking at the housing market to never look at seasonally adjusted data. And if any realtor or an analyst or real estate board or banker tells you or creates a report using seasonally adjusted data, simply throw it out. If you are an investor in stocks that are tied to the new home construction market, then yes, you can use seasonally adjusted data for brand new homes. But I would also give you a caveat there that that data also should be looked at on a non-seasonally adjusted basis, so that you can be sure what you're seeing in the data is true. In other words, a year from now, those houses are actually going to be started. 2 years from now, those houses are actually going to close. And those impacts that they have on the stocks that you're buying, i.e. new cars, new furniture, higher utility costs, rising quality of the housing stock, those items are always going to be impacted by that.
We'll have more with Ross Kay right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Ross Kay. Ross, a listener commented that their financial advisor was recommending against paying down their mortgage, but instead making investments with those funds instead. Have previous generations of homeowners looked at this idea, and is it different today?
They have certainly looked at it, Jim, because, part of our core principle at the Wealthy Homeowner Strategies is directly related to what this financial advisor has been recommending. And for all I know, he gets our pro reports. I don't know. I can't say that this is who it is, but, this is certainly general strategy that every financial advisor in Canada should have been recommending for over 20 years. Now, the problem financial advisors have, Jim, is asking someone to borrow money against their house. In other words, let's not pay down the mortgage, let's invest somewhere else. And where the stumbling block has been for financial advisors over the decades has been their inability to explain to the consumer or the homeowner where their house price is trending over the next 5 years. There has been no facility in the world where such a recommendation is available to a regular homeowner. Now, of course, that's all changed with the wealthy homeowner because we're able to assess these kind of trends for the consumer in this way. What the financial advisors technically doing is they're saying is, look, you probably got a 3% mortgage rate. You probably can get 3% return on your money in the financial market. Your house price is probably dropping right now. Certainly in the major Canadian markets outside of Quebec, your home value is dropping. It makes more sense to invest the money into a rising asset, for the sake of the argument, whatever stocks they're recommending, versus an asset that is devaluing your home. That just makes good common sense. What I would say to this listener is the following. First of all, don't believe anybody, right? You shouldn't believe me. You shouldn't believe your financial advisor. You should ask for the data and the charts to be delivered to you so that you can make a rational decision. You can do follow-up research to see if the suppositions in these charts are correct. In other words, there are a plethora of videos out there online on the rent-to-own discussion right now, Jim, where they use 3% house price gain as the variable of house price change to justify renting over buying. Well, I can tell you, there's nowhere in Canada over the last 25 years where house prices have only gone up 3%. Even Quebec, they've increased more than that. Now, they have to increase more than that, or our country is in a depression. I'm not going to get into the explanation from a home ownership perspective, a wealth effect perspective, why this is true. But I'm going to ask our listeners today, simply trust me. There is no place in Canada where housing prices have only averaged a 3% gain over the last 25 years. Like each year, annually, a 3% average return. Doesn't happen. As soon as you go to 4%, 5%, 6%, all of these calculations are thrown out the window. The same is true with this financial advisor. If they're telling you they can get you 8% returns, probably this is not somebody you want to listen to. You want to listen to the guys the girls that are out there telling everyone, yeah, we can probably get you 6%. It's going to be up and down. You need to leave your money in this. You need to leave your money. You can't pull it out when the market turns down. So my answer to this listener would be this. You should treat every investment in your lifetime exactly the same way that millions, tens of millions of Canadian families have treated their homes. When their house price is dropping, they don't sell it. They simply wait for the market to turn back positive again. The difference between a house and a stock truly is that you're living in a house. We don't look at it that way. We look at it as every single home is an investment. You have two types of tenants. One is the owner tenant, where the owner is a tenant of the property he owns. Or you have non-owner tenants, where a stranger is a tenant in the property that someone owns. And when you look at your housing investment that way, your home ownership that way, it changes your life forever. Your life will never be the same. You see things for how they truly are. And what this financial advisor is telling you is, look, this stock, your house is a bunch of stocks, is dropping in value right now. You can borrow money. Well, you can actually not pay down the mortgage on your house and instead invest that money. And the return on that investment is going to be going up. If you look at them over a 25-year period, well, depending how old this listener is, I mean, they may be near the end of their life cycle. They could be 75 years old. And, they're going to be liquidating their real estate when they're 85. They could be a 50-year-old listener who's going to own real estate for at least probably another 25 to 30 years. They're basically just starting out. This is the period where they're going to build the greatest amount of wealth in their lifetime. And those people should listen to the financial advisor. What I will tell all the listeners is this. There was this, back in the 90s, there was a mortgage broker who came out with the premise that he created a new strategy called the Smith Maneuver. Now, the Smith Maneuver was not new. The Smith Maneuver was old. It was actually called the Bronfman strategy, where the big developer Bronfman used tax savings through leveraging mortgage interest to gain wealth. The Smith Maneuver came out, and it was basically doing the same thing, but on a smaller scale. What is different today, though, is this, Jim. When HELOCs were above 8%, which was there was about 30 years there where home equity line of credit was above 8% annual interest. The stock market had to return a 12% return, guaranteed, for you to have a surety with listening to your financial advisor. Today, a HELOC can be had for around 3.5%. And if you're using mortgage funds, in other words, you're not going to accelerate your mortgage payments. Instead, you're going to invest the money. Then it's only 3% if you got a 5-year 3% mortgage. So the returns don't have to be those aggrandized returns of 12%. When I started the business, Jim, back in the late 1980s, I had financial advisors knocking on our office door at least once a week, telling us we had to get a 12% return on our money, and we needed to invest it with them to get that 12% return. I know today, the best financial advisors in the country tell everybody you should be expecting a 6% return. Two different worlds, two different recommendations, two different realities. This listener needs to look at his reality today, look at the data, make a rational decision, and whatever he decides or she decides, lock it in for the next 20, 25 years, and don't worry about it.
We'll have more with Ross Kay right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, you constantly mention you measure mortgage debt differently than others do. It was recently reported May 2019 recorded the smallest increase in mortgage debt in 3 decades. How do you read May's mortgage numbers?
Oh, great question, and certainly is very timely, because I know the headlines that you're talking about, because, we're sitting here laughing at them at the office. We measure mortgage debt based on mortgage originations. In other words, how much new mortgage debt, net of the mortgage debt being paid off each month, are Canadians taking on. We don't care about the total mortgage debt in the country that has fixated economists and analysts around the world about Canada. The mortgage debt to GDP ratio, we don't care about that. The income to mortgage debt ratio, we don't care about that. Those numbers do not matter, because we are always going to have a constantly growing amount of mortgage debt in this country if our population is going to continue to grow and the quality of life homeowners are experiencing is going to continue to grow. When mortgage debt begins to decrease, if that ever happens, you will be in a depression. Not a recession, a depression. Because that means the quality of your housing stock no longer is improving. It means that your population growth is slowing. It means your country is slowing. When we look at mortgage debt, when we look at May's mortgage debt, first of all, we know that we can't even read mortgage debt from May yet. Regardless what the Bank of Canada or the StatsCan or the banks want to tell you, you cannot read May's mortgage debt until you have June's mortgage debt. Because May's, this goes right back to the first question you asked me today about how Alberta homebuyers were conned. Mortgage debt is booked in a calendar month. These calendar months don't fall in the same days year over year. So when you're comparing mortgage debt, you have to take that into an account. It's why seasonally adjusted mortgage debt is a false metric. It's why you get W charts with seasonally adjusted mortgage debt. The only chart where you don't get a single W is a mortgage origination chart. And it is peaks and troughs in a long period of time, often several years, a few years. You don't get W charts like those that appear on the Bank of Canada's website. We measure mortgage originations, Jim, because we know that house prices are dependent on new mortgage debt being booked. If there is not an adequate amount of new mortgage debt being booked, home prices will decline, which is what's happening right now. The problem with new mortgage origination data is that if you Google it, you will not find mortgage origination data in a single chart created anywhere in the history of Canada. Why that chart doesn't exist, Jim, I don't know. I don't know why that chart doesn't exist. Because I have had one since the early 1990s, and mine goes right from now, goes back into the 70s, right on through till today. It is a causational function of house price change. So, when people are commenting about mortgage debt, and what they're talking about is the total mortgage debt in Canada, or seasonally adjusted mortgage debt, put your ears up. Because what I'll tell you is there's not a homeowner in Canada who cares about the total mortgage debt in this country. They don't even care about their own total mortgage debt. What they care about is their monthly payment. That's it. We are recording in May, this May, for the sake of the argument. We have not this May is produced as much new net mortgage originated in this country than all the way back till May of 2013. So what I'm saying is, this May, the only time May has produced less new mortgage origination debt, was way back in 2013. This is not a record amount of negative debt. If this was a negative month of May, where mortgage growth was worse than 3 decades for a May, for the sake of the argument, which is what I've heard in the news, you would be in a depression, folks. The 80% house price correction in Vancouver that you had heard about on the news would have already taken place. Toronto would be an absolute nightmare right now. The bankruptcy rate would increase drastically in this country. The vast majority of Canadians would be worse off. So I understand, listeners, and I'm an advocate of buying on lowering house prices. That doesn't mean that I don't know with each passing day more and more Canadian families are underwater from what they paid in their property. In other words, they couldn't resell it, plus the fees for what they paid. With each passing day, that number grows. This is a sad thing for us. We hate to think of all of the people, because this isn't just young people. This is also people in their 40s, 50s, and 60s getting ready to retire. They're watching it fall. And if they're not in that next 20 to 25 year window where they can just sit and ride it out, there is huge financial damage being done right now. By measuring new mortgage origination data, we know the magnitude of house price change that can be recorded. Now, that doesn't mean, Jim, we're talking about those ultra luxury class homes of in Vancouver, where you've already seen 30 and 40% reduction. This isn't talking about the houses in North Toronto, where we've already seen 30% house price reduction from 2017. We are talking about the average price that a home buyer is able to pay, which over time impacts every single home in the housing stock. May's mortgage numbers for this May are better than any month except for May of 2013. That's something that your listeners can try to understand. The mortgage numbers released by the Bank of Canada and StatsCan, which is total mortgage debt owing, is an irrelevant number. It is a number created by economists who don't understand that Canadians can handle $1.56 trillion worth of mortgage debt. Of course they can handle $1.56 trillion worth of mortgage debt because they own homes that are currently valued at almost $6 trillion. Look at the ratio. Don't listen to these shills and hucksters out there who are talking about housing markets where they don't have mortgage origination data. Don't listen to commentary about mortgage debt when they're talking about debt to income, debt to GDP, total mortgage debt owned by Canadian homeowners. They are irrelevant numbers that only become a problem when mortgage growth stalls and then falls.
Ross, there's a new home buying platform and brokerages opening up in the U.S. called iBuyer, where the owner of a home gets an offer directly from the brokerage and not a buyer. Do you see this having huge potential in Canada?
Yeah, basically, Jim, this is another one of the scams that is going out there, and it is laughable, the people that believe this is something new. In the United States, there are IPOs in the hundreds of millions of dollars to support this concept, which I will debunk now for your listeners. Guaranteed sales plans have been available to any Canadian in virtually any city in Canada for the last 40 years. We offered guaranteed sale plans to every single one of our sellers between 1990 and when I left the business. The reason why you can offer a guaranteed sale plan, iBuyer program, where the real estate brokerage offers to buy the house, is because you're buying it at a price that is low enough when the commissions are removed in a worst case scenario that you never lose money. You also bind that seller to purchase another property with you. So you still get another 2 to 3% commission on the higher priced property that they generally are buying. What this means is that an iBuyer program is buying your home, technically, at about a 12% discount. Now, we offered this program, Jim, the exact same program, for over 25 years. But I'll tell you, none of our sellers ever took it. Because we laid out the exact financial terms that the house would be purchased under, and we showed them the minimal amount of risk that we were going to accept. We also told them that we have never had a home that we didn't selling for higher than the guaranteed sale price, ever. Thousands of homes, worst real estate marketing history, the early 1990s, we still didn't have a single home that didn't sell higher than what the guaranteed sales price would have been. It is a scam. We offered it by debunking the scam ourselves to our clients. There is no company in the world that is going to offer you market value for your home. It will not happen. They are going to offer you on their opinion of value of the home, which is the lowest probable price your home is expected to sell for over the next 3 to 4 month period. That's what's called a guaranteed sales plan. It will also retake the full commission off of the guaranteed sales price. And when I mean full commission, what I mean is you can't negotiate this amount to be lower. They're going to set it probably at 6% plus GST. They are also going to ask you to sign a contract that if you're buying another house, you're going to buy it from them. They control the entire process. They put you in a position of weakness. We have watched brokerages across Canada for decades use this technique to fool consumers. The guaranteed sales plan is the single greatest real estate con ever created. And that's what these iBuyer programs are. They are now claiming that they use fancy algorithms and market measures of the housing market to come up with the value of your home that they will pay you. It will always be far, far less than even the worst realtor in your local marketplace would probably get you. These iBuyer programs are designed for one purpose and one purpose only: to stop the consumer from thinking. You can sell your house to us, you have no hassle. You can buy a house from us, you can have no hassle. That hassle is probably going to cost you between 15 and 17% of the total value of real estate you're handling in that transaction.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.